S&P 500 futures are dead flat right now in the overnight session.
And the Nasdaq is just stuck in the mud, hovering right below key technicals.
It is Friday, February 20th, 2026. The opening bell is still a few minutes away, and we are staring at a market in a massive valuation standoff. We've got Goldilocks economic data colliding head-on with a geopolitical pressure cooker.
The VIX is sitting at 16, and global trading desks are just refusing to blink.
Right.
This is the absolute definition of a macro Friday. The stakes are incredibly high today because we have a paradox right in our faces.
The overnight catalyst.
Exactly. You look at the data released this morning, Q4 advanced GDP coming in at a resilient 4.4%, and the core PCE price index cooling to 2.4%. I mean, on paper, that is the holy grail.
Yeah, that is the soft landing we were promised.
It is.
But the real risk here, and this is a part that drives retail investors crazy if the numbers are the holy grail, why isn't the implied open a gap and go? I mean, 4.4% growth with inflation dropping, that should be confetti time. We should be seeing a massive gap up. Instead, pre-market volume is anemic and we're paralyzed. Why is good news suddenly treating us like bad news?
Because the good news for the economy is actually bad news for liquidity. And that distinction is everything.
That's the mission of today's deep dive, right? Unpacking why excellent economic numbers are being met with fear. We need to explain this liquidity trap we are currently stuck in and identify the specific lines in the sand you need to watch today.
Because there are two massive shadows hanging over this market right now. You've got the risk of a Friday fade due to the Iran-U.S. nuclear deadline, and a potential AI derating flush that is actively threatening the tech sector.
Let's start with the macro landscape. We have this GDP PCE disconnect. Advanced GDP is 4.4. Core PCE is 2.4. You said this is bad for liquidity. Explain the logic there.
It comes down to the bond market vigilantes.
The institutional guys controlling the debt markets.
Exactly. They're looking at that 4.4% growth number, and they aren't seeing a soft landing. They are seeing an economy that is running way too hot.
Too hot for what, though?
Too hot to justify rate cuts. I mean, the market has been pricing in a Fed rescue rate cuts to help valuations. But if the economy is growing at 4.4%...
The Fed has zero reason to cut rates.
Zero. The vigilantes see this and they sell bonds, which drives yields up. This is the higher for longer threat manifesting in real time. Just look at the 10-year Treasury yield this morning. It's sitting at 4.08%.
Which is structurally elevated.
Highly elevated. And the dollar index, the DXY, has ripped to a 4-week high of 98.07.
Okay, so the Fed put this idea that the Fed will step in and save the market is essentially gone because the economy is too strong to need saving. And that strong dollar is just a killer for multinational earnings.
Right.
But let's layer the next problem on top of this. You have strong growth keeping yields high, but then you have this geopolitical layer. Geopolitics as a tax.
You cannot trade this market today without looking at the Iran ultimatum. President Trump has issued a 10 to 15-day deadline for a nuclear deal.
And that clock is ticking loud.
Ticking loud enough for every trader in New York and London to hear it.
So uncertainty usually equals cash. People go to cash.
They go to cash or they hedge. This uncertainty is driving WTI crude oil to 7-month highs, sitting above $66.80. And for a trader, that oil price acts like a tax on every other sector of the economy. If energy costs go up, your margins go down.
Which brings us to a specific mechanic we need to define for you listening, the Friday fade. In trading terms, it's a very specific behavior pattern. Why is it such a high risk today?
It's Risk Management 101. In this specific environment with oil rising and a geopolitical deadline looming, traders are terrified of holding risk over the weekend.
Because of headline risk.
Exactly. Think about it. If you're a portfolio manager running billions, do you want to be long equities holding massive amounts of tech stock if a headline breaks on Saturday regarding an escalation in the Middle East?
You can't sell on Saturday. You are stuck until Sunday night futures open.
You are locked in. So the Friday fade is when traders sell into any strength today just to de-risk. They're essentially flattening their books so they can actually sleep at night. They would rather miss a 1% rally on Monday than get caught in a 5% gap down because of a weekend news cycle.
So even if the open is strong, the trap is thinking it's a breakout. The real risk is that it gets sold off by 2:00 p.m. as the big money heads for the exits.
Exactly.
Let's talk about the specific levels here. We promised lines in the sand. Let's look at the S&P 500, the ES futures. Where are we sitting?
The S&P is currently in what we call a liquidity trap.
Define that for the listener. Liquidity trap.
It means the price action is sandwiched between two opposing massive forces. On the upside, you have the resilience of the labor market. People have jobs, they're spending
Keeping a floor into the market.
right. But on the downside, you have energy costs and rising yields pressing down on valuations. The price is just bouncing like a ping pong ball between them. The pivot point to watch today is 6,925.
And if we break above 6,925, bulls win.
Not immediately. The critical line in the sand for the bulls is 6,950. We absolutely must clear 6,950 to negate the risk of a Friday fade. If we can't get above that, the sellers remain in complete control. That 6,950 level represents the ceiling of this current trap.
And on the downside, if the bears take the wheel, where does the floor actually fall out?
Watch the overnight session low of 6,870. If the S&P loses 6,870, the consensus is that it triggers a rapid slide down to 6,845.
That's where the bulls de-risk aggressively.
Yeah, that 6,870 level is the trapdoor. If it opens, you do not want to be standing on it.
Tech is the weak link because it's the most sensitive to interest rates. The Nasdaq, the NQ futures, is stuck below its 50-day exponential moving average, which is sitting at 25,339.
And in technical terms, that signals a distribution phase.
Right.
Translate distribution phase for the active trader listening. It is the polite way of saying the smart money is selling to the dumb money. In a distribution phase, institutional money is distributing selling stock gradually to retail investors who think they're just buying the dip. They're offloading their bags before the price drops further.
Man, that is never what you want to hear if you were holding calls. What is the barrier level that matters for the Nasdaq today?
There is a massive psychological barrier at 25,000. Markets love round numbers. If tech cannot reclaim 25,000, the rotation out of tech and into value and energy is going to accelerate.
It becomes a self-fulfilling prophecy.
Exactly. Algorithms are literally programmed to sell if that 25,000 level breaks.
This leads perfectly into the pain trade, because I know a lot of listeners here, tech is down and their immediate instinct is to buy. We've been conditioned for a decade that every dip in tech is a buying opportunity. Why is this time actually different?
It's different because the fundamental math has changed. We need to talk about the AI derating flush. This is a cost of capital problem.
Let's unpack that. Cost of capital. Derating. It sounds like institutional jargon, but explain how it actually hits the retail wallet.
It's simple math, but it is brutal. When you buy a tech stock, especially an AI darling, you aren't buying it for the cash it made yesterday. You're buying it for the earnings it will generate in 2030 or 2035.
Right. You are buying future cash flow, the dream of future profits.
Exactly. But you have to discount those future dollars back to today's value. And the rate you use to do that discount depends entirely on the 10-year Treasury yield.
Which is pushing up.
Right. When the yield rises, and remember, we're moving toward 4.25%, the risk-free rate goes up. Mathematically, that makes those future earnings worth significantly less today. That's the discount rate at work.
Wait, so even if the company is executing perfectly, even if their AI tech is amazing, the stock price has to come down just to make the valuation math work?
Precisely. A rise in yields mathematically lowers the fair value of tech stocks, period. So here is the retail trap. You see a stock down 5%, you think, oh, it's on sale, it's cheap.
Buy the dip.
But to an institution running these models, that stock's fair value might have dropped 15% because of the yield spike. So at down 5%, it is actually still expensive relative to the new interest rate environment.
That is a crucial distinction. What looks like a discount to a retail trader is actually a premium to an institutional algorithm. You're buying an asset that hasn't fully repriced yet.
You're buying the anchor while the ship is still sinking. You are fighting the math, and the math usually wins.
Let's get into these specific movers and shakers this morning. We have some heavy action in the pre-market volume. Let's start with the giant. Walmart, ticker WMT. They are trading up 0.4% pre-market. Why is an old-school brick-and-mortar retailer outperforming high-tech?
It's a fascinating story. Walmart hitting record highs isn't just a defensive play anymore. It is a victory for their AI-driven supply chain. For years, the narrative was Amazon would crush everyone.
Sure.
Walmart has flipped that script. They are using AI to manage inventory so efficiently that they are beating Amazon at its own game.
So it's not just a consumer staples play. It is a tech-enabled logistics win.
It is a real economy AI win. That's the key phrase. Investors are rotating out of vaporware AI companies that might make money with AI someday and into companies that are using AI to save money right now. Walmart is the poster child for that today.
Speaking of the tech side, let's look at Palo Alto Networks, ticker PANW. They're seeing a slump, down 2.5% pre-market. Why?
This is the chill in the air for the software sector. Palo Alto beat earnings, but their guidance was highly cautious. They are flagging slower cybersecurity spending.
And when the leader of the pack sneezes,
The whole sector catches a cold. This is sending a negative signal through the entire SaaS software as a service sector. It reinforces that cost of capital trap we just discussed. Companies are tightening their IT belts.
and then we have a classic beat and bleed scenario with Dropbox, ticker DBX, down 4.16%.
Frustrating for shareholders, but totally predictable in this environment. They beat earnings, but the guidance for fiscal year 2026 was weak. It barely met the midpoint of expectations.
Which isn't enough anymore.
No. In a zero-interest rate world, barely meeting is fine. In a high-yield environment, barely meeting gets you punished.
What is the support level to watch on Dropbox today?
The bear case level is $26.80. That is the primary support zone. If it breaks 26.80 on heavy volume, it signals a definitive trend shift to underperform.
Now here's one that might signal something broader about the macro economy. Copart, ticker CPRT, down 6.64% after an earnings miss. They posted 36 cents versus the 40 cents expected. Why does a salvage yard stock matter for the macro picture?
Because Copart deals with salvage vehicles, the used car market. A miss here signals a potential peak in the cyclical used vehicle market. It suggests that secondary market liquidity is drying up fast.
Which means what for the consumer?
If people aren't buying used cars or if the underlying values are dropping, it is a massive red flag for the consumer economy. It means the average consumer might finally be tapped out.
But there is one bright spot amidst the red tape today. Hims and Hers, ticker HIMS.
The outlier. They are gaining momentum tree market because they announced a definitive agreement to acquire Eucalyptus. This is a highly strategic move to expand into the APAC region, specifically targeting telehealth in Australia.
Now, usually the acquirer drops on news like this because they're spending cash. Why is HIMS gapping up?
In this specific case, the market sees the deal as accretive. It adds value immediately to their bottom line. The bull case level to watch today is $24.25.
So if it breaks 24.25.
It confirms investors see this as a smart growth play, opening the door for a run right back to 52-week highs.
So putting this all together, we have weakness in tech, strength in real economy logistics like Walmart, and specific idiosyncratic moves. Where is the big money actually flowing? We keep hearing about the Great Rotation.
The Great Rotation is the dominant theme of 2026. Just look at the performance divergence. The equal-weighted S&P 500, which treats every company the exact same regardless of market cap, is absolutely crushing the cap-weighted index.
Give us the hard numbers on that.
The equal-weight index is up 5.8% year-to-date. The cap-weighted index, which is incredibly heavy on the Magnificent Seven in tech, is up only 0.2%.
That is a massive spread, 5.8% versus basically flat.
It tells you everything you need to know about institutional flow. Money is fleeing AI vaporware and moving aggressively into real economy value. We're seeing massive flows into utilities and consumer staples.
People want tangible assets.
They want tangible assets and they want dividends. They want things you can actually touch.
But here's the paradox. There's always a paradox. Semiconductors are up this morning.
Right.
Up 0.47% pre-market. Aren't they the ultimate growth and risk trade? If we are rotating to safety, why are institutions buying chips?
That is the semiconductor paradox. Despite the rotation, semis remain a liquidity magnet. In the pre-market right now, they are acting as a safety play, almost like a reflex.
A safety play? How?
Traders are thinking if Iran escalates, defense spending goes up. Who makes the advanced chips for the drones and the missile systems? The semis.
So it's essentially a geopolitical hedge.
It feels like one, but, and this is a huge warning for anyone trading the open, this safety bid evaporates instantly if yields spike. If the 10-year breaks out, semis will catch down to the rest of the tech sector violently. It is a very fragile safety.
So we have the levels, we have the movers. What is the explicit strategy for you listening right now as we stare down the opening bell?
The strategy, to stay nimble. Do not chase the open. We are in a liquidity trap, which means we're going to see lots of churn, lots of noise, but maybe not a lot of true direction until we get past that 10.0 a.m. Eastern data dump.
Right. We are waiting on the services PMI and more institutional digestion of the PCE data.
Exactly. If that 10.0 a.m. data comes in hot, the line in the sand supports we talked about, the 6,870 on the S&P, the 25,000 on the Nasdaq, they will crumble. You do not want to be fully invested 9.35 a.m. if the floor falls out at 10.05.
And the final indicator, the one thing every trader should have on their screen today.
The 10-year Treasury yield. It is sitting at 4.08% right now. If it breaks 4.0%, the AI momentum trade officially becomes a liquidity exit.
You do not want to be the last one holding the bag if that yield crosses 4.7.
Definitely not.
Okay, let's unpack the bigger picture before the bell rings. We've talked about the mechanics, but what does this mean for your mindset going forward? Because frankly, looking at this data, it feels like the rules of the game have completely changed.
They haven't just changed, they have inverted. It raises a fundamental question about the market era we are actually trading in right now. I mean, for 15 years, the winning strategy was growth at any price.
You bought the disruption, you ignored the crazy valuations, and you knew the Fed had your back. The era of free money.
And that era is dead. Now we are operating in a world of 4% risk-free bonds. We have geopolitical deadlines that are real, not just weekend noise.
The cost of capital is no longer zero.
Exactly. So the provocative thought you need to consider before you execute a single trade today is this. Is your portfolio still built for a market that no longer exists? Are you holding on to a 2021 strategy in a 2026 reality?
Because if you were just sitting there waiting for the Fed to save the high multiple tech trade,
You might be waiting a very long time. The market data today is screaming that value, cash flow, and tangible assets are the new kings.
a sobering thought to take into the weekend. Watch your levels. 6,950 on the upside for the ES, 6,870 on the downside. Watch that 10-year yield, and whatever you do, watch out for the Friday fade. We will be watching it all right alongside you.
Stay safe out there today.
That is it for this deep dive.
Good luck at the open.